What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's #2 economy. My name is Tony, let's jump in. Happy Tuesday everybody. There has been so much going on in the last few weeks, both within China, like lockdowns and stock market volatility, or overseas, like of course the war in Ukraine, that it's easy to forget that China's property development sector, representing anywhere from 20 to 30% of the Chinese economy, depending on how you count, is still very much in crisis. I've said from day one that I believe that the Evergrande crisis, that is the wider housing crisis that Beijing policymakers have been grappling with for the last several months, will likely not bring down the Chinese economy, though this is because I predicted that policymakers would back away from the sorely needed structural reforms to China's growth model and pump up the housing sector or another overbloated one like infrastructure spending to avoid the pain that true deleveraging of the housing market would require to achieve those reforms, and simply pushing the issue back a few more years until it returns again bigger than before with a vengeance. However, this being said, this crisis is complex and highly damaging, both to the real economy and to the confidence of investors, business, and households. There is the possibility that it will be mismanaged, resulting in a painful financial and economic fallout. And of course, there is also the possibility, though narrow, that the deleveraging campaign and the system-wide reforms are successful, which has its own consequences for the world's #2 economy. Any one of these outcomes is hugely consequential for the global economy and geopolitics. As such, we will continue to follow the housing sector closely here on China Update. I expect Evergrande and others will be in the headlines a lot more this year. And when the proverbial excrement hits the fan, we will not be surprised because we would have been following it closely and in detail. Indeed, we should all see it coming before it hits the mainstream media. Today's video will focus on the housing sector, looking at both the forest and the trees. Trading was halted for the shares of China Evergrande Group and 2 of its units on the Hong Kong Stock Exchange just yesterday, on Monday. So I think the timing is right for another deep dive into this housing crisis. We're seeing many massive property developers in pain as they shoulder both the double hit of regulatory restrictions on borrowing due to Beijing's fears of financial systemic risk, and the hit to revenue from the collapse in sales of properties in recent months. On top of this, investors have dumped their dollar bonds, pushing average yields above 30% recently and making it too costly for developers to raise money in the debt markets. This may have come as a surprise to many regulators in Beijing, who likely hoped that the market would impose greater investor discipline, that is, incentivize lending to healthier developers and disincentivize supporting poor-performing ones. However, this didn't exactly work, because the capital markets had been operating in an environment for so long in which the safe bet was to back actors or sectors supported by the government, so that when the government pulled back that implicit support, investor confidence in the entire sector simply evaporated. Industry giant Country Garden Holdings Co., one of China's financially stronger developers and a firm bigger than Evergrande, reported a 14% decline in its average selling price in January and February year on year. This was a mild drop compared to other players though. Logan Group, for example, a mid-sized developer, recently told investors that its average selling price collapsed close to 40% year on year during the same period, January and February of this year, as sales tumbled generally in the market. Of course, we already knew the sales in these 2 months had been smashed looking at the official information coming out, but we'll be touching more on this index a little later in this video. And most analysts looking at this data predict that the trend will continue into March and perhaps even into the second quarter. To avoid defaulting, many real estate companies are now rushing to sell assets as quickly as possible. We remember looking at the example of Soho China a few weeks ago, which wants to sell 9 properties in Beijing and Shanghai at a 30% discount to pay off debt. China Vanke, or Vanke in English, V-A-N Co, another developer that the market had thought safe due to its strong state backing, recently offered 19% discounts on listings that they have not been able to sell in almost a year now. This is putting tremendous downward pressure on home prices, which local governments have been instructed not to let fall. The collapse of China Wangke, or Country Garden Holdings, would be a much more devastating hit to the market than Evergrande's defaults were last year. Things are made worse with household demand disappearing. One property agent in Zhengzhou, the large provincial capital of Henan in central China, expressed to a reporter this week, quote, "People have lost confidence. On one hand, they are worried that developers won't be able to finish the construction, therefore they will lose money. On the other hand, they are worried that prices will keep dropping." End quote. So we have a glut of properties coming to the market and people not willing to buy. Anyone with half a semester's worth of intro to economics could tell you that there is a gap here, an issue of supply and demand. By the way, guys, if you're enjoying the episode, you're getting some value from it, it's always a massive, massive help if you hit that like button. If you're watching for the first time and you enjoy this sort of content, whether on the property sector, the Chinese economy, or Chinese macro developments generally, maybe consider subscribing. I have one of these. I release one of these every day, typically 5-6 days a week. So if you want to be on top of the most up-to-date analysis, hit that subscribe button and the bell notification, and you'll have these as they're released. The official numbers coming out of Beijing and data from think tanks is already quite pessimistic. However, commentators point out that the current situation may be even worse. The National Bureau of Statistics decided on the list of 70 cities back in 2005 to make up its housing price index, which it still uses today, and many analysts and commentators use this data to produce their analysis of the sector. Some analysts point out, though, that the index has a disproportionate focus on cities whose housing prices are stronger, typically the larger and wealthier cities. The problem is, it's the smaller and poorer cities, the ones with high levels of population outflow and chronic oversupply of housing in many cases, which are seeing the biggest downwards pressure on prices. Put simply, in China, real estate markets in smaller cities are suffering deeper contractions than those of larger cities. It is argued, therefore, that the housing crisis is worse than feared by officials and investors alike due to the skewed weighing of the housing price index of the National Bureau of Statistics. And keep in mind, all these big developers in major cities are also heavily exposed to lower tier cities too. Indeed, Yao Zipei, an analyst with Huaxi Securities, just this week expressed, quote, "I believe most of these developers' properties are in lower third or fourth tier cities." End quote. This week, the Wall Street Journal published a report looking at this exposure and the lengths that developers are going to sell these properties in these lower tier cities. Quote, "Logan Group, which has a major presence in southern China, has been promoting some of its properties in the region. One in Liuzhou, a third-tier city in Guangxi province, has offered buyers incentives comprising discounts of more than 20% off the property's price, 5 years' worth of management fees, and a raffle for home appliances." End quote. And quote, "In Xinyang, a third-tier city in Henan province, a developer recently advertised," now quoting the advertisement, "buy a house and get a luxury car." End of advertisement. Continuing with the original quote from the Wall Street Journal, "Buyers of selected apartments can get cars worth 100,000 yuan, or RMB, the equivalent of about $16,000 US, while some purchasing villas could receive a Mercedes-Benz worth 300,000 RMB. End quote. These properties, however, are not popular. One property firm executive speaking to Chinese financial media outlet Yicai expressed this week, quote, "Lots of the projects that distressed developers have put on sale are located in small cities and fail to meet our investment standards." End quote. And finally, one last aspect to look at, a theme which we've been following closely on China Update, is the growing role of the state in the property development sector. From the increased local government financing vehicle purchasing of land use rights from local auctions, to mergers and acquisitions with crisis-hit private firms, to the expansion of state-owned rental properties. Over the past 2 months, Sunac, China Holdings Limited and Shimao Property Holdings Limited, two debt-ridden Chinese private developers, which we have been following for months now. Both big players have sold projects worth billions of RMB to state-owned firms. Quote, "This marks a sharp reversal from 2018 to 2019, when the two companies went on a shopping spree, spending tens of billions of yuan, RMB, to expand their businesses. How times have changed. China's real estate industry, once a breeding ground for new billionaires, has degenerated into a minefield of murky debt risk that threatens its status as a pillar of economic growth." End quote. Sunac is China's third largest developer by sales. Ratings agency Fitch recently expressed, quote, "Sunac is planning to sell other projects in the next few months, including residential projects in Beijing and Shanghai, to state-owned asset management companies." End quote. It then downgraded the massive developer's credit rating. Shocked by the extent of the fallout in the property sector, regulators have in recent months relaxed bank loan rules regarding mergers and acquisitions, and encouraged big, healthy developers to buy the property assets from crisis-hit firms. The problem is that there are not many healthy developers left in the private sector, so state-owned enterprises were given marching orders to make these purchases. The problem with this is, though, even state-owned developers have been reluctant to buy. Quote, "Although healthy real estate firms, especially state-owned ones, have been encouraged to bid, many are cautious because they worry the deal might end up costing them money." An executive responsible for mergers and acquisitions at a healthy developer said the company required an up-for-sale project to have an estimated net profit margin of at least 10% before it considers putting in a bid. Previously, that was not a high bar, but for the first 3 quarters of 2021, the average net profit margin of Chinese mainland-listed real estate firms fell to 6.4% for residential projects and 9.5% for commercial projects. In addition, potential buyers are concerned that some assets might be too burdened by debt with inflexible repayment obligations that will weigh on them. End quote. Caixin analysts give the example of 34 projects that Shimao want to sell, with all but 3 being used as collateral. According to the report, many of the 34 were financed with trust loans that carry interest rates as high as 10%. Tomorrow we'll go back to the format of following major developments across geopolitics, the economy, and other major domestic affairs in China. Now, one of the stories that we'll be touching on tomorrow relates to the firm which started all of this mess in the first place, Evergrande, who has a very tough week ahead of it. See you tomorrow. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.